The non-virtuous or lazy discussant usually faces two stark choices. A, say that this is a wonderful paper and then go on to talk about his or her own work. B, say that this is a lousy paper, I'll show you how it's going to be done, and then talk about his or her own work. Neither of those choices is open to me because this is not an area that I've worked in. So I have to take a different tack. And my tack is basically going to be the following. What I'm going to do is think a little bit about what Ricardo's model tells us about how one should think about the fiscal footprint of macroprudential policy and what other policies might be implicated in thinking about this broader set of issues. And then to apply it to the emerging market context, which Ricardo started doing, but which I will develop to a somewhat greater extent. So the nice thing about this paper, as you've seen from the presentation, is that it's very elegant in one very specific fashion, that it has just the right amount of detail. As academics, sometimes we are prone to adding more details than are necessary in our models to make the point we want to make. And this is a very spare model. It has just the right level of detail to study what Ricardo wants to study, which is the fiscal impact of macroprudential policies. And he does this in a very specific and simple way. And he makes the point that, again, this is not meant to be truly representative of macroprudential policies, but for his purposes, it works very well to summarize macroprudential policies as being measured by the amount of government bonds that banks are required to hold. And there is only one dynamic channel in the model. There are no other nominal rigidities or other aspects of dynamics. The financial channel is the only dynamic channel. Bonds offer liquidity benefits, which is why households in the model end up holding bonds. There is, as we know from the work of Annette and others, a downward sloping demand curve for government bonds, and that's loaded into this model. So the macro effects he points out are that changing this beta can affect the cost of rolling over public debt, but at the same time, higher beta means lower lending, lower real activity, lower tax revenues. But in terms of crises, there is a bit of a trade-off. A higher beta means that there is a lower incidence and a lower fiscal cost of a financial crisis, but at the same time, there is a greater probability of a fiscal crisis. So the contribution of the paper, which I think is really neat, is that it gives us a way of explicitly measuring the fiscal footprint of MP policies. Now, it is a very cool thing in a geeky kind of way to say macro-pru. But I have two teenage daughters, and the one lesson they have taught me is don't try to be cool. So I'm just going to say MP policies. The nice thing about this paper is that it bridges a variety of literatures. The demand for government bonds, the interaction between fiscal and financial crisis, the diabolic loop literature to which Ricardo himself has contributed, and banking regulation. So what we get out of all of this is a very nice framework for studying the interaction between fiscal and macroprudential policymakers. So these two extreme cases are nice ways of framing this relationship. In a financial crisis, a tighter macroprudential policy eases the fiscal burden, and the fiscal and financial stability goals are aligned. In a twin crisis, you have a reverse problem. The diabolic loop essentially amplifies the fiscal impact of MP policies. So this raises a number of interesting questions, and many of these questions become even starker when one thinks about the other cases, the fiscal crisis where there is a large fiscal dominance of MP policies, and twin crises where MP has a large impact on fiscal policy. Now, we've had in the discussion in the morning and also in this paper, the question about whether independence of other policymakers is desirable. And behind all of this, especially as we economists sometimes tend to become, central bankers tend to become macroprudential policymakers, but on occasion some of us do become finance ministers, but less so. There is this notion that finance ministers or those in charge of fiscal policy are essentially undisciplined cretins who need to be reined in by the wise, somber technocrats who are the central bankers or the macroprudential policy makers. But Ricardo's paper puts his question front and center. whether it is desirable for these two aspects of policies to be separated explicitly, macroprudential and fiscal. And the question is whether these can be this independence can be sustainable when the policy goals are not aligned. So one can take this in different directions. One can think about whether, in fact, one can flip the issue around, whether you can have a monetary policymaker or indeed an MP policymaker going rogue. One could potentially conceive of a situation where a macroprudential policymaker decides that financial stability is such an important overarching goal that the beta needs to be set really high. And setting beta really high has all these negative effects on the macroeconomy, and the fiscal authority may in fact end up being constrained to ease fiscal policy, which it turns out will be easier to do in this case because the cost of rolling over public debt will be made easier by the MP policymaker. So there is an interesting question about whether, rather than just having fiscal dominance of MP policy, you may end up with an independent MP policymaker essentially putting the bind on fiscal policy in a particular sense. So it brings to the fore, it's not obvious what the right setup might be in terms of the degree of independence between a fiscal policymaker and a macroeconomic policymaker. And that brings up another set of questions which Ricardo's model wisely doesn't try to tackle, but I think his framework gives us the ability to start asking questions of this sort. We've heard about the fiscal dominance of monetary policies in the old literature. Ricardo has given us a framework for looking at the fiscal dominance of macroprudential policies, but in the real world that we live in, but not in the general equilibrium model that Ricardo laid out, where there is no central banker, these two policies are both going to be affected by fiscal policy. So one interesting question that does come out of this is, what is the degree to which fiscal policy is apportioned between monetary policy dominance and macroprudential policy dominance? And this is an intriguing question if we start thinking about it, because there are trade-offs between whether the dominance ends up being on monetary policy or on macroprudential policy. At a time when many central banks around the world are trying to generate more inflation, it would be a lot better if the dominance fell, if the fiscal dominance fell on monetary policy, because central banks are trying to raise inflation towards their inflation targets, at least the advanced economy central banks. But in a different world, one could very well conceive of a scenario where it would be better for most of this fiscal dominance to fall not on monetary but on macroprudential policies. So I think it would be really interesting to extend this framework to think about how one might generate a trade-off between how fiscal dominance gets split up between these two policies, and it may also be related to the relative credibility, the relative efficiency of the different policymakers. Now, there is one assumption that is sort of important here. It's sort of implicit, and it's not exactly correct the way I'm phrasing it, that bank deposits are safe, because there is a way, as Ricardo pointed out, for bankers to run away with deposits. But it does look like in the basic version of the model, government bonds are subject to default, bank deposits are somewhat safer. But the question is whether that is really the case. In the diabolic loop literature as well, there seems to be this implicit presumption that somehow bank deposits are senior to government bonds, that government bonds can default, and ultimately you're going to have bank bailouts, but usually you have the sovereign default taking place before that. But one can very well conceive of a scenario where you might end up with depositors recognizing that bank deposits really may not be senior to government bonds, and this in fact could trigger a flight away from government bonds, from bank deposits into government bonds. Now, this may seem a little far-fetched, but in Ricardo's model, it has a very specific implication, because if you have this scenario, it affects the way one thinks about the equivalence of different policies. Ricardo told us about a very interesting exercise where you can compare conventional, unconventional monetary policies and macroprudential policies based on the effects on the price of government bonds. But in this scenario, where you might have a flight out of bank deposits into government bonds, you may find it very difficult to actually conduct that comparison experiment. There are other issues as well that one could think about in this framework, whether lower interest rates, given that we live in a world very close to the zero lower bound, really does have the effect of increasing inflation. Many central bankers would only wish that this were the case. This could affect some of the dynamics of the model if you're trying to relate it to present economic conditions. And there is also a question about whether a prudent MP policymaker would want to find a different menu of financial assets to get around the diabolic loop problem that Ricardo talked about. This is a closed economy model, and there is another intriguing set of questions about whether the results would be altered in an open economy setting, because the interactions among these three sets of policies, fiscal, monetary, and macroeconomic policies, could be quite different. So to think about that point, let me talk a little bit about these issues in the context of emerging markets. I tend to think a little bit more about emerging markets where there are specific circumstances. Ricardo comes from an economy that is, I guess, still borderline advanced. It's not emerging market yet. But emerging markets, as he correctly pointed out, not just in Latin America, but elsewhere, do have high required reserve ratios. But there are a number of perversities that exist in those economies compared to the economies that lurk behind Ricardo's model, which I see as a largely advanced economy construct. Because in advanced economies, in fact, you do get this liquidity premium on government bonds, but in emerging markets, having banks and other institutional holders of government bonds dominate those markets actually reduces liquidity. So again, you have this very odd effect in emerging market economies that the typical sort of advantage of holding government bonds tends to be reduced by macroprudential policies themselves. And of course, in many emerging market contexts, macroprudential policies are more akin to capital controls, and the logic for many of these policies is really related to managing capital outflows and reducing the exposure to foreign currency debt. So the dynamics of the sort of things that Ricardo is talking about can tend to be quite different in an open economy setup, especially where many of these features that are in his model don't quite apply. But in addition, in emerging market economies, there is a complex set of issues that ends up determining the entire spectrum of interest rates, both policy and otherwise. And financial repression through low deposit rates, credit caps, and so on means that you can effectively run macroprudential policies in a different way by indirectly controlling the bank's demand for government bonds. So in fact, you may end up having what looks like a macroprudential policy outcome in terms of a high beta, but very often it is the consequence of other policies. So to just illustrate that in the couple of minutes I have left, let me turn to an economy I like to think about, which is China. Now in China, it turns out that there is a peculiarity that I had looked at in some of my work related to the exchange rate regime. You know, in emerging market economies, typically, trying to intervene in foreign exchange markets and sterilizing those reserve interventions creates huge quasi-fiscal costs. China, for a period, was accumulating a huge amount of reserves, and they didn't seem to be bothered by these quasi-fiscal costs. It turns out there was a reason. These quasi-fiscal costs were not only quasi-fiscal, but in fact, they were completely buried. So if you look at what happened during the period 2006 to 2007, the two lines at the top are US interest rates, and the lines below that are yields on Chinese government bonds. So during this period, there was this remarkable phenomenon that every dollar that came into the Chinese economy that the central bank, the PBOC, recycled by reserve accumulation actually made money for the central bank, because the amount of money they were paying on the sterilization instrument was lower than the rate of return they were getting on US government bonds. So stimulated by Ricardo's paper, I went out and looked at a broader aspect, which was how banks were faring in this time relative to their deposit rates. So in China, there is a baseline deposit rate, and banks know better than to try to deviate very significantly from that. So the baseline deposit rate does have a lot of traction. But look at this remarkable feature that if you look at the yields on treasury securities at the short end in China, they are below the deposit rates that Chinese banks were paying on their deposits. So why on earth were Chinese banks taking the deposits, willing to buy Chinese securities at these low rates? Unfortunately, the required reserve ratio part got washed out here, but the required reserves during this period did fluctuate a great deal, but are still around 15 to 16%. But what made this work was essentially a combination of a relatively closed capital account, financial repression, and credit caps. So Chinese banks are essentially told not to lend out more than whatever their mandated credit caps were. So you end up having policies that have very similar effects in emerging market economies. So the framework that Ricardo has, I think, is already a very rich one. But I think it's important to keep in mind that what happens in emerging market economies and what might look like applications of his model that are working out are in fact reflecting some very different forces. But having said all that, it's a very elegant paper, and although I do not have an alternative to offer in terms of my own work, I think it's well worth a read because at a minimum, it gives us a very good framework to think about a set of issues that I think deserve much deeper thought than they've received in the literature so far. Thank you.